Hello, everyone. Welcome back to another episode of Signal or Noise. This is episode 68. Charlie Bilello here, and with me, as always, Peter Mallouk. Peter, we had the big State of the Union this week. A lot of talk about that. We are not going to be discussing that. We're going to be discussing the state of the markets, talking about the stock market, the bond market, the Fed, inflation, the economy, and much more. So stick around to the end. And I want to start here with the stock market. It's been one of the most interesting 2 month periods I could see in a long time. If you go back in history, very interesting what's going on so far this year. But if we back up to the beginning of 2025, just an enormous reversal in terms of performance between U.S. stocks and international stocks. Emerging market stocks since the beginning of 2025 up to today, up over 50%. That's a 14-month period, 50% gain. European stocks up 45%. And the U.S. stock market still doing pretty well, but a big spread here, up 19%.
Absolutely incredible. 2010, United States earned zero. Everyone's like, why am I investing here at all? Then you go to the next decade and U.S. crushes absolutely everything, primarily because this rotation back, which they never ring a bell for. And then coming into the new decade, everyone's predicting international is going to do better. Vanguard, BlackRock, Goldman Sachs, literally everybody. And for the first 5 years, U.S. trounces international again because of big tech and the AI revolution happening inside of big tech. And so pretty shocking to everybody. Last year, international stocks, emerging market stocks began an epic, relentless run, largest spread in history, outperforming the U.S., which, to your point, Charlie, has done better than expected as well. Because the overall market's doing well, but to have emerging markets up over 50% over 2025 and so far this year, and European stocks up over 45 relative to the U.S. 19, I mean, unbelievable run. Of course, we got a whole new shift now. People saying, why do we have anything in the U.S.? Clearly, people want to move away from the U.S. Countries don't want to invest in the U.S. We've got the tariff issue and everything else. And of course, the answer is no one rings a bell when the rotation is going to happen. And all the reasons international stocks, emerging market stocks are outperforming the U.S. this year, all the reasons given, better dividend yield, better PE ratio, sentiment, and so on. Those reasons existed years ago. There's nothing new. It's all of those facts were already there. It's just a rotation that happens without an announcement and without the ringing of a bell.
Absolutely. And this really reinforces why you need to be diversified in advance of the change, because by the time, let's say this is going on for a few more years, and then you start thinking about diversification, well, then it might be just in time for move back in the other direction. But what's fascinating so far this year, Peter, it's not just international and U.S. stocks in terms of that reversal. We've seen a reversal also in the other major factors, namely mid caps and small caps outperforming large caps, and value stocks outperforming growth stocks. As you know, last year we saw continued underperformance in those areas, but this year I'm calling this the everything reversal, because we have international stocks up over 10%, mid caps 8%, small caps 7%, value stocks close to 7%. The U.S. stock market still up 1%. But you have growth stocks, which were the leaders for more than a decade, down 4%, and the Magnificent Seven down a little over 5%.
I mean, the reversal people have been predicting forever. Small cap beating large cap, finally happening. Does it have legs? Does all of this have legs? We're going to find out. But you're right. To go from growth to value, from large to small, to U.S. to overseas, we have a 15-year narrative that's finally been broken over the last 14 months. The question is, how long will it run?
And nobody knows. And that's why you have to continue to be diversified. And if we look at the sector picture, Peter, this is kind of stunning for a 2 month period. Energy and materials leading all of the sectors year to date, up 23%, 18%, as we talked about. The S&P up around 1% year to date. So huge outperformance in commodity related areas. And then you have the really leaders in the last 15 years, particularly tech stocks, discretionary, consumer in the consumer space, and communication services, all down year to date. Do you make anything of this sector rotation, or is this just something you see over and over again in markets?
Well, we see it over and over again, but I think that this is explainable in a different way than the rotation we see from U.S. to international and emerging markets, or from large stocks to small stocks, which seems to be more sentiment-based. This is based on a real fundamental change that is occurring in front of our eyes, which is we used to look at big tech as unstoppable. No one and investors loved nothing more than a subscription based model, that Netflix model. Every month people pay again and again and again, and every year it's adjusted for inflation. And there was nothing more of a darling than these enterprise based solutions like Salesforce and companies that provide software like that, where you're charging a per seat license every single month for every single user, and the cost of changing and the hassle of changing is so significant. And of course, we saw the announcement by Anthropic, which is the maker of Claude, which is an AI solution. Some people might be more familiar with OpenAI's Chat GPT, same general type thing. And people are starting to see that, hey, AI bots might be able to create enterprise software at a much lower cost. And if this really happens, should we be paying these enormous multiples for this? The idea of buying the subscription based software companies was, hey, this is going to go on for 10, 20, 30 years. No one's going to switch. It's going to go up in price every year. What's better than this? Well, if the cost of entry drops substantially and the cost of customization drops substantially, then companies will go through the hassle of a switch. And the market just does not know how to price this in. So the sector rotation we're seeing now is anything that can be taken out by AI getting absolutely destroyed in the market, and anything that seems not susceptible to being taken out by AI, like your chart showing energy is the number one performer, materials number two, consumer staples number three. I mean, is Colgate and going to get taken? Is Procter and Gamble and ExxonMobil going to get taken out by AI? Of course, AI will impact everything, but to a different degree here. And I think that's why we're seeing the sector rotation.
It's amazing how the narratives shift, how quickly they can shift. Because, of course, initially it was tech is going to benefit, and tech has benefited a lot from the AI wave. But now there's this huge differentiation within tech. And you talk about software. And if you look at the software ETF here, I'm showing goes back to 2001. Usually, Peter, it trades in tandem with a broader market. A lot of big names in this ETF. You got Microsoft, you got Oracle, you got Salesforce, and many other big names people are familiar with. And now we have this unusual situation because of the fears over AI disrupting the software sector, where they're down over 33% from their peak. And you have the S&P 500 sitting near all-time high. So the question, of course, as always for investors, is this overdone? Is it overblown? We haven't really yet seen a big hit or a hit at all to the earnings of these companies, but really the market is starting to price in what you said. Maybe they deserve a lower multiple if they're going to be disrupted. What's your best guess here? Is this an overreaction in terms of the fears of what this might do to the software industry?
I think it is impossible to predict what's going to happen, but I actually do not think it is overblown. If you made me bet, I would say I do not believe it's overblown. Do I think that the sector will come back? Yes, because I don't think things are imminent. But I think this idea that this is going to go on, that enterprise software is going to go on for decades and it's as untouchable as it was a few months ago, I just don't think that's true. I think there's several things I think are objective facts. One, AI is real and it's coming. Two, it's going to be able to program things much more efficiently than people could do on their own. And three, by definition, that lowers the cost of entry and it lowers the cost of switching. The only question is how much? Like how much? Yes, companies like Salesforce are going to use AI to improve upon their software, and they've got a head start, so it will benefit them as well. But how far away are we from a company being able to go, look, I'm going to create something custom to us using technology, hire a few consultants to use AI, create something custom to us, and then I'm willing to go through this cost to remove a permanent recurring expense from my books. I mean, there's a lot of motivation here. So I think that this is a real threat, a legitimate threat, and not a false alarm.
Okay, we'll see what happens here. I think the lesson for investors here in terms of sectors is there's always a sector winning, there's always a sector losing. The nice thing about diversification is you don't have to pick the sector winners of the future. And if I showed you a chart, Peter, of the last 10 years, S&P 500 versus the software sector, they're essentially the same in terms of performance over the last 10. And what you saw during the first 5, 6 years, software way outperformed, particularly after COVID. All of these same names were being bid up by enormous amounts. And now we've seen a reversion to the mean. So the question from here is Are we going to see a further decline in this sector? Nobody knows, and that's the nice thing about diversification is you get all of the different sectors in there. And sometimes it's going to be energy and materials and staples, boring things, lifting your portfolio higher. And other times it's going to be these more excited technology areas. And no one can predict which is going to be the winner of the future. And then, Peter, we have to end with talking about earnings here because really this is the fundamental driver in the long run. And you're talking about earnings growth over the past year for the S&P 500, about 13%. We have about 74% of companies reported so far. So that's the backdrop going on with all of the rest of the noise. And if earnings continue to grow, that's going to continue to be the story. In the short run, you're going to have many different things that investors are worried about. But in the long run, this is what really matters, isn't it?
Yeah, you're exactly right. At the end of the day, it's the only thing that matters is future expected earnings. Eventually, stock prices follow. The key word is eventually, but everything else is noise.
Okay, let's move on to here. The bond market, the Fed. We have a fascinating thing going on in the bond market, Peter, because it's the longest drawdown in history for the bond market, been going on since 2020, but we're almost out of it. And if you look at this chart here, it was 18% drawdown, was a record for the Bloomberg Ag at its low in 2022. Nobody wanted a bond. And then bond returns, of course, since then have been pretty good because yields have risen. So we're less than 1% off of the high from 2020, likely to get there within the next few months in terms of hitting a new total return high. And you can see on the chart here why that has occurred because yields were at record lows in 2020. You're talking about less than 1% on the 10-year, which portended very bad bond market returns. We got that. Yields rose, bond prices fell. But once bond yields got to 4 to 5%, Peter, you start earning that coupon. And that's why we've clawed our way out of the drawdown. And you see the yields here on the 10-year hit close to 5% in 2023. And now we're at 4%. So you got a little boost from that decline in yields. When you talk about bonds with investors, I know you have a framing and how they should size it and position it, but this is the chart I often come back to, Peter, in terms of what should bond investors expect from returns for the next 7 years. Well, it's pretty much that starting yield again and again and again.
Yeah, if you look at the actual bond returns, 99% of the return is the yield. I mean, default risk is the other component, the odds that whoever's paying you back, whether it's the government or a company, goes under. Of course, you're not going to get anything back. But absent that, you're going to get the current yield. And so, with all the fluctuations that go up and down based on the movement of interest rates day to day, if you're wondering what your bonds are going to return, look at the individual bond, look at the yield. That's going to be your long-term return. I don't know, Charlie, if you saw the recent release from Vanguard where they're predicting a 60-40 portfolio with 40% bonds may outperform an all-stock portfolio. I believe that's what they said. I think they've got very low expected returns for stocks going forward. Of course, they had the same very low expected return for stocks coming into this decade. If you followed their advice, you got just absolutely destroyed as an investor. But now they're doubling down on it, really expecting very low single-digit returns for stocks. And they feel that bond yields where they're at now, as you pointed out, a little higher, are very close. And for much, much less risk, you can get a similar return going forward. I don't agree with that, by the way, but it's just fascinating to hear.
It's all about time frame, right? So what they're essentially saying is over the next 7 to 10 years, usually they do 10-year projections. So next 10 years that the stock market's going to yield in terms of total return less than 4% per year. Now, has that happened before? Yes, we know. We saw it in the 2000s decade. Could it happen again? Absolutely. Is that typical of a 10-year period for stocks? No, absolutely not. So if we're looking at a global portfolio, not just the US stock market, and we say next 10 years are going to be 4% per year, that would be on the lower end of the spectrum. Not impossible, which is why you should have bonds in your portfolio to get you through that period of time. And even if their stocks return 4% or less than 4% a year over the next decade, it's not going to be linear. It's not going to happen 4% per year. You're likely to have bear markets during that period of time, corrections. It's going to be a volatile path in getting you to that level. But as we know, if we're looking at 20 years, 30 years, there's never been a period where the stock market hasn't outperformed cash, which is why you want to be an owner in the long run. Let's talk about the Fed here, Peter. A lot of noise in terms of the Fed. But if we look at the very short term, what the market is saying is the Fed is not going to cut anymore under Powell. Powell's chairmanship ends in May. We got 2 more meetings. The market's saying no chance the Fed cuts interest rates. But then in June, we're going to have Kevin Warsh take over as Fed chair. And the market's predicting, at least for now, 2 interest rate cuts under Warsh. Of course, he's not the only voting member of the Fed. There's another 11 members, which is why I think there's going to be a fight this year in terms of there's going to be a camp that wants interest rates substantially lower, and then another camp that wants to hold the line. What do you think in terms of interest rates here and the Federal Reserve?
Well, I mean, these charts are famous for being where we look at the market expectations. Once you get out past a year, they're kind of famous for being wrong, which is interesting. I do think even though the Fed's supposed to be independent, I think we've got probably a political back channel here, where I do think that we're not going to see anything with Powell. I think that's for sure, and I do think we're going to see the cuts afterwards, because I think there's probably a tacit agreement for that to happen. And we're going into an election year. And I think that there's a lot of pressure from Trump. And I don't think you're getting that seat if you haven't tipped your hand a little bit. And maybe that's a little cynical, but that's how I see it. How about you, Charlie?
Yeah, I have no doubt that he'll be voting for a few interest rate cuts. If you actually look at his history, he's really been on the more hawkish side, which is kind of interesting. So we'll see. It may end up being a pick that Trump maybe regrets, because if we see inflation moving in the wrong direction, it's going to be very hard, I think, to justify a lot more cuts. Another cut or two, absolutely, but to get interest rates down where President Trump wants them, 1% or below. He's talked about having the lowest interest rate in the world. That doesn't seem in the realm of possibility. And I say that because of where inflation still is here, Peter. We're talking about 58 consecutive months now with inflation. If we look at the Fed's preferred measure of inflation, core PCE, it came in at 3%. It's 58 straight months above that 2% Fed target. And as you and I have talked about, this notion of a 2% target, it's an absolute myth. The last 5 years, inflation has averaged more than double that target, about 4% per year. So what sense is there in having a 2% target if you're absolutely going to ignore that and keep cutting interest rates? That doesn't make any sense to me.
Yeah, complete total joke. I mean, you can't have this situation and be lowering rates into it. You're going to just further create a wealth gap, which, I think people like Ray Dalio that are sounding the alarm around this are right. You're going to have big repercussions down the road if you don't get it under control. There's just no signs it's going to be under control anytime soon.
There's a big, people might say, what's the difference? 2%, 3%, 4%. There's a big difference, obviously, Peter, over 10-year period, 20-year period, if you're annualizing inflation at 2% versus 4%. Very big difference in terms of the cumulative price increases. And I think this is still the number one issue for a lot of people. It's not that inflation over the past year is super high. We're talking about 3% increase here. It's the last 5 years cumulatively that people are struggling to keep pace with that.
Yeah, I think that we're finally seeing a little bit of an uptick. We're seeing positive signs with wage growth, but I mean, we've got a long way to go to close the gap.
So let's talk about the housing market here. And obviously, big factor for a lot of Americans. Many Americans, their biggest asset is the equity in their home. So a big factor. And we've talked about the housing affordability or lack thereof. I've called it the least affordable housing market in history. A lot of reasons behind that, mostly the intervention from the Federal Reserve and the federal government. And what we're seeing now, Peter, is really a normalization in terms of price increases. Last year, we saw a 1% increase in the Case-Shiller National. This is national, of course, every region is different, but a 1% increase would be the smallest yearly gain for this index that we've seen in a long time. And the question here, Peter, is what should people be expecting from the housing market? We know what's happened in the last 5-10 years, abnormally high growth. What should be people expecting over the next 5 years?
I think this is going to be really, really fascinating. I think there's so many different factors happening. You've got the biggest generation in history getting ready to exit their homes, downsize, and you've got a smaller generation coming in for the first time. It's just that to me is a fascinating trend. But that new generation doesn't like the same type of homes, particularly on the bigger end, the McMansion end of things. So I think you've got that interesting demographic issue. Then you also have all these people locked into low mortgage rates, which, one solution would be if Trump gets what he wants, which is significantly lower rates where mortgage rates follow. that would start to unlock people that are kind of mortgage trapped. Or if you had mortgage portability, that would solve that problem too. And then, of course, without all this artificial stuff, supply and demand always fixes things, right? If there's not enough homes, builders come build more homes. If there's too many, they slow down. It's not perfect. We have periods of pain. I think there are too many variables to make a prediction over the next few years around housing. What's your take, Charlie?
Yeah, I'm going to make a prediction here, not in terms of where prices will be on a nominal basis, but on a real basis, adjusted for inflation. I think that's going to be very difficult to see further gains from here. We're at coming off record levels. Finally, we had a year in 2025 where wages outpaced home prices on a national basis. I think that will continue for a few years. It could grow. We could grow our way out of it and take years of kind of flat home price appreciation with people's wage gains, or we could see what we saw during after the last housing bubble. We saw about a 25% decline nationally. Nobody knows the path it's going to take, but supply and demand rule the day in the short run. And as you talked about, the mortgage rate is a big factor for most people. They're financing the cost of a home. That's down now to 6%, likely to go below 6% this week. But that still, unfortunately, doesn't change the affordability math because prices increased it so much. And we're talking about a change in mortgage rates from under 3% to still a little over 6%. But supply and demand really comes down to affordability, Peter. So if you don't inject artificial stimulus into the housing market, there's more sellers than buyers. This is going to keep price increases down, and places where there's fewer zoning restrictions. We're looking at Texas and Florida primarily. Prices are already coming down, and meaningfully so in many areas.
Yeah, I agree. And to your point, that this is a big if. If there's no artificial interference, yes, things will solve themselves.
All right, so we'll see about that. Obviously, it's going to be a big issue in the midterm election, but a lot of different views in terms of how to solve it. Peter and I did an episode a few months ago. Check that out in terms of how you could have solved the affordability crisis. We are not pursuing any of those things whatsoever so far, but maybe finally at some point people will say the solution to the problem can't be the problem itself. But that's wishful thinking, I think. Let's talk about the economy here, Peter. We have to talk about the tariff situation. This was kind of expected. You and I expected this. Looking at the letter of the law here, it seemed like the tariffs that were imposed last year were not an emergency in terms of what that statute was talking about. And so the Supreme Court said, no, these tariffs were illegal. They struck them down. But the confusing part, Peter, is that almost immediately President Trump came out and said, all right, we can't use that statute. We're going to use another one. And now they're going to do a 10% global tariff. And then 2 days later, he said, no, let's do 15%. And it's 50. So here we go again in terms of the tariff confusion. Where is this all going to shake out? I have no idea. To me, the big takeaway is none of this is permanent at all.
I mean, the day after the Supreme Court ruling, Federal Express became the first company to sue to ask for all of their tariff tax money back. Last night in the State of the Union, President Trump said he sees these tariff proceeds as replacing the income tax as we know it. I mean, this is a story that's got a lot more chapters to go. It's going to be fascinating to see how this unfolds.
Yeah, that seems highly unlikely considering the tariff revenue. Even if we're doing 30 billion a month, that's 300 billion a year. We're talking about 5 trillion in terms of the income tax revenue coming in. So you're gonna have to do much, much bigger tariffs to get there. And so, of course, the question, as you talked about, from FedEx, many companies are going to want a refund. This will probably take time, but it seems likely that they'll get some of this money back, only then to have to give it back again under the new tariff regime. I have no idea where this is going to shake out. I just know that the notion that any of these trade deals, as we talked about last year, it's like every week there's a new trade deal with a different country. What happens to all of those trade deals after this ruling? Nobody knows. This is such a moving parts. But what I would say, Peter, is just looking at the data overall. If we looked at 2025, and I didn't tell you any of this tariff stuff went on at all, and it was just business as usual. And I showed you this chart here of the deficit, trade deficit in goods in 2025 versus 2024. You say that looks like nothing happened. The trade deficit actually widened a little bit in 2025, up 2%, hit a record high versus 2024. So even with all of this tariff stuff going on, it didn't really move the needle in terms of its intended purpose, which was to substantially reduce this deficit. Now, some will push back that it's going to take time and this will look a lot different a year from now, maybe, but so far there hasn't been as big of an impact as many people projected.
There has to be some stories, some reasoning behind this that's not so obvious. It doesn't come top of mind to me, but I do wonder how much the wealth effect in the United States might be driving some of this, and what kind of, if the type of goods that come in have changed a little bit. We might have the same number, but I wonder if there's been a rotation in what it's spent on.
I think there's a few. I'll tell you a few factors going on. Number one was the massive front running that we had in the first few
Sure.
months before the tariffs, and number two is there's general inflation, right? So you're paying a higher cost of goods, so you expect it to go up. But still, all else equal, you would expect if you're raising the tariff rate from 2% to 15%, you would expect the dollars of imports to go down. Maybe it will this year, but clearly the impact hasn't been felt just yet, which means that maybe the price increases, as we talked about, are still yet to be pushed through. So many different moving parts here, hard to speculate. But if we look at GDP growth, Peter, and I showed you this number again, 2.2% in 2025. There's a lot of talk, 4, 5, 6%. We've talked about the deficit, the national debt. There's a lot of talk. We're just going to grow our way out of it. Number comes in at 2.2%, and 2024 is 2.8%, 2023 2.9%. So just kind of a normal year here with everything going on in terms of the US economy.
That's right. I mean, I think that at the end of the day, the economy's doing pretty well. We're not going to grow our way out of any of our deficit problems, but we're not in crisis mode despite all the chaos either.
Absolutely. And if we look at the unemployment rate here, I think this is what I point to in terms of this time is different because the unemployment rate usually after it hits a low starts going up, it continues to go up, you have a recession, and here we're kind of meandering at a still very low rate, 4.3%. The big question of course being, are we going to see not just a slower in terms of slowdown in terms of hiring, which is what we've seen, but also an increase in terms of the number of firings. We haven't seen it yet. We talked about AI and all the impact it's having. Peter, we still haven't seen massive layoffs. Is that coming? That's the big fear in terms of AI,
I
that
mean,
it's only a matter of time.
City just coming out with their prediction of unemployment of over 20% in a few years. I mean, I do think we're going to see a spike in unemployment. I don't think, I just, what it's going to be, I think is unpredictable. Are we going to see an uptick of a couple 1%? Is it going to be 4? I mean, 4 would be pretty impactful, right? But if we get anywhere near where we're seeing some of these predictions of 10, 20, 30%, it will be a whole new world that none of us have ever experienced in a lot of ways. So it is going to be a fascinating thing to see unfold.
Yeah, and it could certainly go up. A lot of people are asking my view in terms of historically when you have these new technological innovations, Peter, what have we seen in terms of disruption and job loss? And for sure, it's happened. The types of jobs have changed, and unemployment goes up in the short run. But there has never really been a period where we've seen a technological innovation, and after digestion, after the change in the types of jobs, that it hasn't led to ultimately more jobs. And so the question is AI different? The speed at which the change is going on, that seems to be very different. But in terms of this being just yet another technological innovation, so perhaps we could see the same where there's a period of disruption, but and the types of jobs change, but the growth in terms of the overall pool is actually be higher 10 years from now than today.
Yeah, I
That's
think
the
this is
optimistic view.
Yeah, the optimistic view is, whenever we see technological revolution, it expands the economy and unemployment does not go up, and the quality of the jobs gets better, moving from manufacturing to service. I think AI is going to be interesting because AI isn't just about making some folks more efficient; it's about replacing. Some of it will just flat out replace some of the roles, and not just a few of the roles. And I think that's what's going to be interesting: is what new jobs get created. Is it going to be 1 for 1 or 10 for 1? It's just too unpredictable, but we're going to see this story unfold, not over decades, but over years.
All right, so let's end here with something positive here. My favorite chart for an economy. This is comparing wages in the US, so average hourly earnings, to reported inflation. And so I have to say reported because that's what we're looking at here. But the good news, Peter, is it's 32 consecutive months of wages outpacing reported inflation. And that followed a pretty bad period of over 2 years of negative real wage growth. So when people ask me, why is the economy still doing well? Why is the consumer still doing well? Well, the unemployment rate is still low, and we're seeing wages outpace inflation now for almost 3 years.
And this is very, very healthy. I mean, you had kind of the working class in the United States in a crisis where the cost of everything had rocketed and their wages did not keep up. I mean, the wage gap, their ability to cover basic needs is becoming threatened. And we are finally seeing some momentum of real wage growth here. And so I consider that very, very positive.
Absolutely. And when people ask me, why are you so against the Fed continue to cut interest rates? I point to this chart. We're in a good place. I don't want to see inflation go back up and be a problem again. I like real wage growth being positive. So let's keep this going on. And I would like to see this go on for many, many more years if possible. So, Peter, let's end it right there. If you're watching this, thinking about your portfolio, your financial plan at Creative Planning, we're here to help. Reach out to us today, creativeplanning.com/Charlie. Get a free wealth path analysis at Creative Planning. We're in all 50 states, so we likely have a location right near you. Over 700 billion in assets under management and advisement. And we're here to help. So reach out to us today, creativeplanning.com/Charlie. Thank you everyone for joining us today on Signal or Noise. If you're watching this on YouTube, hit that subscribe button. We're also available on Apple and Spotify. And Peter and I will see you next time on Signal or Noise.